Hi friends, in this video we are going to learn strategic management accounting past papers. These questions evaluate return on investment, residual income and target costing subjects. If you think this video is useful, please like this video, share with your friends and subscribe this channel and click the bell button for getting the notification of the forthcoming videos. Okay, let's go to the video. B part of the first question. Most of the public companies are preferred to divisionalization its operation in order to manage effectively and improve its performance. The first is explain the advantages of divisionalization. First advantage, divisionalization can improve the quality of decision making. So decision making is improving by the divisionalization. Second, decisions can be made more quickly. So we can make the decisions quickly. Motivate divisional managers. The divisionalization is motivating decisional managers of the organization. Second is differentiate the concept of residual income and return on investment in assessing the performance of the divisionalization. So first we know the residual income. What is the residual income? Residual income is a measure of the sender's profit after deducting imputed interest cost. So we can calculate the residual income like this: divisional profit minus imputed interest cost. What is return on investment? ROI. Return on investment shows how much profit has been made in relation to the amount of capital invested. So the return on investment is a performance measure used to evaluate the efficiency or profitability of an investment or compare the efficiency of a number of different investments. Return on investment tries to directly measure the amount of return on a particular investment relative to the investment's cost. So we can calculate the return on investment: divisional profit divided by capital employed into 100. The third part, Alpha Limited has two investment centers X and Y which show results for the year ended 31st March 2021 as follows. So Alpha Limited have two investment centers, those are X and Y. Divisional profit is given: X has 300,000, Y has 150,000. Capital employed is given 2 million for X investment center and 600,000 for Y investment centers. Cost of capital or imputed interest cost is given 12% for both investment centers X and Y. So first we have to calculate the ROI, return on investment. We know already how to calculate the return on investment. This is the equation to calculate the return on investment. Equations is divisional profit divided by capital employed into 100. So divisional profit is given in the question for X investment center 300,000. 300,000 is divisional profit for X, divided by capital employed. Capital employed is given 2 million for X, 2 million into 100. answer is 15%. So return on investment for the HNDA is 15%. And Y, divisional profit for Y investment center is given 150,000 divided by capital employed for the Y is 600,000 into 100. For the answer, return on investment of the Y is 25%. So now we have calculated the ROI for X and Y investment centers. Now we are moving to calculate residual income RI for the both investment centers. Now we have to calculate the RI, residual income. Here divisional profit is given 300,000 for X, 150,000 for Y. Now we have to calculate imputed interest cost or cost of capital. The percentage is given as 12%. We can calculate the imputed interest cost like this. Imputed interest cost equal capital employed into cost of capital. So capital employed for the X and Y. There are two investment centers. X and Y. There are two investment centers X and Y. Capital employed is given in the question. X has 2 million, Y has 600,000. So 2 million 600,000. Cost of capital 12%. So the interest cost, imputed interest cost is capital employed into cost of capital 240,000. For the Y, capital employed 600,000, cost of capital 12%. So imputed interest cost is 72,000. So 240,000, 72,000. Now we can calculate the RI, residual income, for both investment centers. The equations is divisional profit minus imputed interest cost for calculating the RI. So divisional profit is 300,000 minus 240,000 and Y 150,000 minus 72,000. So the answer is RI for X investment centers 60,000, RI for Y investment centers 78,000. This is the answer for this question. Second sub question of the second main question in the 2019 HNDA SMA past paper. Define the target costing. So we should identify what is target costing. The target cost is calculated by subtracting the desired profit margin from the target selling price. For example, if a company has a target selling price of rupees 200 and a desired profit margin of rupees 40, so we can calculate the target cost, target selling price minus desired profit margin. So target selling price is 200 rupees, desired profit margin is 40 rupees, so target cost is 160 rupees. Third part. The following is the summary of the information that has been presented to the management by the earlier enterprises. So this information is given in the question. Sales unit 400,000, target selling price 1000 per unit, target profit margin 25%, and actual cost per unit is 700 rupees. So we are required to calculate the target cost per unit and state the variance of profitability compared to the target cost. So first we have to calculate the target cost per unit as per the information. So we know already how to calculate the target cost. Target selling price minus desired profit margin equal to target cost. So target selling price per unit is given as 1000 rupees. So 1000 minus target profit margin, target profit. We can calculate the target profit. How to calculate the target profit? Target profit equal target profit margin minus target profit margin into target selling price. So target profit margin we know in the question 25% into target selling price. Target selling price is given in the question as 1000 rupees. So profit margin 25%, target profit margin 25%, target selling price per unit is 1000 rupees. So target profit 25% into 1000 rupees, 250 target profit. So minus target profit as 250. So now we can calculate target cost. So target cost per unit is 1000 rupees as target selling price, 250 rupees as target profit. So target cost is 750 rupees. So now we have calculated target cost. After that, we have to calculate actual profit for compare the variances. To calculate the actual profit, target selling price, we know the target selling price as ₹1,000 and actual cost is given in the question as 700 rupees. So minus actual cost. So actual profit is 1,000 rupees target selling price. So selling price per unit is 1,000 rupees and actual cost is given in the question as 700 rupees. So actual profit is 300 rupees. Now we can state the variance of profitability compared between actual profit and target profit. We know the target profit is given in the question 250. It is calculated 250 and actual profit also calculated as 300 rupees. So target profit 250, actual profit 300. So deviation between the actual profit and target profit is 50 rupees. Deviation is 50 rupees. So we know the state the variation. So now we can state the variance between the actual profit and standard profit, actual profit and target profit. So the actual profit is increased by ₹50 from the target profit. So target profit is increased by ₹50. This is the variation. This is the variance. Fifth question of the 2018 HNDA Strategic Management Accounting past paper. The second sub question. A new company has non-current assets of ₹460 million, which will be depreciated to nil on a straight line basis over 10 years. So non-current assets, fixed assets, 460 million. It will be depreciated on a straight line basis over 10 years. So 10 years lifetime. And net current assets will consistently be ₹75 million and annual profit will consistently be ₹40 million. ROI is measured as return on net assets. Required calculate the company's return on investment on years 2 and 6. In the question, ROI will be measured as return on net assets. So first we state the important information from the question. Value of non-current assets is 460 million. And the depreciation will be on a straight line basis over 10 years. So depreciation method straight line, lifetime 10 years, and net current assets will consistently be rupees 75 million. So net current assets will be 75 million consistently, and annual profit will consistently 40 million. So annual profit consistently 40 million as per the question. And additional information is ROI is measured as return on net assets. So ROI on return on net assets. Okay, these are the informations is given in the questions to calculate the ROI on years 2 and 6. So first year, the depreciation, the company will be made depreciation in first year. So non-current assets 460 million, depreciation for first year first we should calculate the accumulated depreciations for first 2 years. So accumulated depreciations for first 2 years. We can calculate the accumulated depreciation for first 2 years. Non-current assets value divided by lifetime into number of years. So non-current assets value is given in the question as 460 million, divided by lifetime is given as 10 years. So 10 years into number of years. So we need first 2 years depreciation, so into 2. So answer for the accumulated depreciation for the first 2 years 92 million. Now we can find the carrying value of the non-current assets. Carrying value value brought forward 460 million cost of the assets minus accumulated depreciation for the first 2 years 92 million cost of the assets minus accumulated depreciation. Cost of the assets is given in the question 460 million. Accumulated depreciations for the first 2 years we have calculated as 92 million. So answer for the carrying value of non-current assets 460 minus 92, 368 million in the end of the second year. So now we can find the total assets or total net assets. Total non-current assets minus total current assets. Here total non-current assets is calculated as 368 million. We can find the total assets or total net assets, total non-current assets plus total current assets. Total non-current assets is calculated 368 million plus total current assets is given in the question as 75 million consistently. So answer for the total assets or total net assets 368 plus 75 443 million. Now we can find the ROI, return on investment, in the second year. Return on investment ROI equal net profit divided total net assets into 100. Net profit is given in the question as annual profit is 40 million. 40 million divided by total net assets is calculated 443 million into 100 rupees. So answer is 9.03%. 9.03%. Now we have calculated return on investment in second year. Now we are moving to calculate return on investment in sixth year. Sixth year. So first we have to calculate the accumulated depreciation for the sixth year. So accumulated depreciation equal value of non-current assets divided by lifetime into number of years we need 6 year depreciation. So non-current assets value is given 460, lifetime is 10 years is given in the question. We need 6th year accumulated depreciation. So number of years 6. So answer for the accumulated depreciation for 6th year 276 millions. Now we have to calculate net non-current assets. Net non-current assets or fixed assets. Cost of non-current assets minus accumulated depreciations. So cost of non-current assets is, as per the question, 460 millions minus accumulated depreciations is calculated 276 million. So answer for the net non-current assets is 184 million. Now we have to calculate total assets or total net assets. Total non-current assets plus total current assets. Total non-current assets is given calculated as 184 million plus total current assets is given consistently in the question 75 million. So total current assets or total net current assets 75 million. So total net assets or total assets 184 plus 75 259 million. Now we can calculate the ROI. ROI in 6th year. End of the 6th year, we can calculate the ROI. Equation for the ROI, net profit divided by total net assets into 100. Net profit is given consistently 40 million per annum. So 40 million divided by total net assets is calculated 259 million into 100. So answer for the return on investment in the 6th year 15.44%. 15.44% in the 6th year return on investment. Third sub question of the first main question in the 2017 HNDA Strategic Management Accounting past paper. The following is the summary of the information that has been presented to the management by the Silva Manufacturing Company. This information is given: sales unit 300,000, target selling price is rupees 800, target profit margin is 30%, actual cost per unit is 600 rupees. You are required to calculate the target cost per unit and state the variance of profitability compared to the target cost. So this is the information given in the question. First we have to calculate the target cost per unit. We know already how to calculate the target cost. Target cost equal target selling price minus target profit. So target selling price per unit is given in the question as rupees 800 rupees. Target profit we have to calculate. Target profit we can calculate target profit margin into target selling price. Target profit margin is given in the question as 30%. target selling price per unit is given as rupees 800 rupees. So target profit is 240. Now we can find the target cost. Target selling price minus target profit equal to target cost is 560 rupees. After that we have to calculate actual profit. Actual profit equal target selling price minus actual cost. Target selling price is given in the question as 800 rupees. Actual cost is given 600 rupees. So actual profit we can find target selling price 800 minus actual cost 600. So actual profit is 200 rupees. Now we have to calculate the deviation between the actual profit and target profit. Target profit is 240 rupees is calculated, and actual profit also calculated as rupees 200. So deviation between the target profit and actual profit is 40 rupees. So we can state target profit is reduced by rupees 40. So target profit is reduced by rupees 40. This is the answer for this question.